All right, we're back for another financial wrap up with Mr. Michael Zuber. How are you, buddy?
I'm doing well, man. It's a long weekend for a lot of people, 3-day weekend. So if that's you, enjoy it, have some fun. Don't forget to make some memories, be safe, and don't forget to continually look at your buy box. The work never stops.
The work never stops. This is true. Absolutely. This is Memorial Day weekend. This is May the 23rd, 2025. Let's get right into it. Redfin goes negative on housing. What is that all about, Michael? Break it down.
So Redfin is the latest housing analyst to go negative on housing. What does that mean? It means that they expect home appreciation to post a negative number at the end of 2025. I believe at the early start of this year, they were calling for something right around 3% appreciation. They are now negative 1%. Again, just so we're clear, national median home price, existing home sales, just so we can put a pin in that. And really, it's kind of the basic story, right? Inventory is up 30%, demand destruction, uncertainty, all of these things. And they now expect housing to post a negative number of 1%. The other thing that's interesting on this is all the analysts, including Redfin, have been increasingly negative. So what do I mean by that? It's not unreasonable for us to think that the next time they update their forecast, which I think is about every 6 to 8 weeks, they'll even be more negative.
Yep.
Again, until the trend is reversed, it's like, okay, guys, well, you went from 3 to 2 to 1 to 0 to negative. All right, give me the next one. So I think they're just reacting to the news. They don't kind of think ahead like we do on this channel. If you guys remember my call for January, it was plus or minus 1% for the year, and I haven't changed that at all. Also, I called for less than 4 million in existing home sales at the beginning of the year. So I haven't changed my opinion in 5 months and likely won't change it in the next 7 months. So there you go. Redfin's negative.
That's why I love these discussions, the Friday show. Michael, just for the audience, Michael said this 6-9 months ago. That's what was going to happen. And so now when we see Redfin, Realtor.com, NAR, we'll see everyone else follow. But basically, they're saying that two things I want to point out here for the audience, especially if you're a new viewer or listener. The crash bros are wrong. The market's not going to crash in spite of all the crazy first 4.5 months of the year, right? Was it crazy?
Yeah, I warned you the first 6 months are going to be bananas. And so far, I've been right. So far, that's probably been my best call ever. It's the first 6 months of Trump's term are going to be chaotic. That was a good call.
Chaos is what you said. Chaos and uncertainty. And then, of course, what did we hear the media say? Uncertainty, uncertainty, uncertainty. And then, again, you called this, though, because, again, there's still all the crash bros. We're talking about crash. You said, no, it's not going to crash. There's not enough supply. There's not enough transactions for the thing to crash.
Yeah, it's just not enough distress. If you want to have a reasonable conversation about some damage in 2026, we can have that conversation, which I've started to think about 2026. But yeah, 2025 is just going to be a shit year. And again, what did I say? I said it's going to be the last hard year, and it's going to be the hardest of years if you're in real estate and mortgage. And again, haven't changed my opinion since January. So yeah, we're kind of in it. It kind of sucks right now.
I 100%. We're in it. We're going to keep our eye on it. Thank God we have you doing all the research and, spending tens of hours every week, knowing what's going on, doing the research. So let's keep going. Let's talk about, now this is Memorial Day weekend. Traditionally, you and I laugh pre-roll, right? For you, right? I said, hey, a 3-day weekend. I've got young kids in school. So for us, we're going to do some fun stuff. Tell them what you told me about the 3-day weekend.
I typically try to avoid 3-day weekends because it's amateur hour out there and everything's chaotic and lots of people are doing lots of things. And I just want no part of that. I've worked very hard in my life where, I'll go out on a Tuesday or I'll go out on a Thursday as opposed to just being one of the masses, out there Memorial Day. It's just I don't have to be there and I won't be there.
Yeah, the masses, and then it rhymes with masses. There's another word.
Exactly. Yeah, just drop the M.
Yeah. Okay. All right. So let's talk about this weekend. You and I love to work. We work. Work's our favorite. Sunday, we're going to do some work. Tell people what we're doing. I'm excited. You're excited. Tell people what we're doing on Sunday.
Yeah. So once again, Inside School, we are going to be going live 8 a.m. It's, it may be a 3-day weekend for you. So if you can't join, no hard feelings. But Ty's going to be our guest speaker. Ty's going to come on with 30 years experience, 31. I have 25. So you're going to have 50 years of experience of people in the real estate industry. Ty runs a big business, does lots of creative financing, he's been a giver forever. I do want to tweak one word that Ty said. Ty says we like to work. I would like to say we like to give. Nothing I do feels like work. If it felt like work, I wouldn't do it. But yeah, we're going to be giving back. And the other thing I want to talk about school, it's really funny. I got some feedback from the financial firefighter, Mark, that somebody joined school and then was disappointed that I take my Sunday morning lives and post them on YouTube. So they canceled their subscription. First of all, good. If you don't think it's valuable, but I thought it was odd that the person canceled their subscription because they didn't think there was enough uniqueness inside school. So let me remind you what you get. First off, you get access to 400 people going the same direction. We have curated a growing population of people going in the same direction, and more of them are networking together. That's unique. Second, we've put out thousands of dollars in education, myself, yourself, Jason Pritchard, and others, that you would probably have to spend $5 to $10,000 to get in any other form we give for free. Next, we have 7 different accountability groups with a multifamily accountability group just spinning up in the last couple of weeks. We now have 7 that you can join. Next, I give you access to me most Sundays of the year to ask me questions live. And then you're pissed off because I take that video and post it on YouTube to show everybody else out there that we are unique, we are good, we are moving. So, you know what I might do is I might just keep them private if that's such a thing that maybe I won't post them. But I don't know. Let the audience tell me. Should I post them? Should I keep them private? Again, as I've told everybody, I have no idea what I'm doing. Right? This whole, building a business or a brand or something is completely foreign to me. So, I thought I was doing a good thing by highlighting the uniqueness of One Rental at a Time, but maybe I'm cutting off my nose to spite my face, and I should create more behind the curtain and secret stuff. But I don't know. I have no idea what I'm doing.
I think you're doing great, man. And I will say this, it's wild because this, just a short little story. So just about a year ago, actually, I'm with Michael. I stay at his home with him and Olivia. We spend a week together filming video content, working on projects, talking about what's next for One Rental at a Time. I start telling Michael, well, do this $500 a month program, $1,000 a month program. And then I said, then come up with this really kind of exclusive, maybe like a $10,000, $15,000 membership 1 year. like we talk about kind of like
I remember
the value ladder, right?
I remember. Yeah. I remember.
2 weeks later, Michael goes, I've got it. Thank you for all your help. We literally on a whiteboard, just so people know, he and I spent in that office where you're sitting at. Yep. We have a whiteboard and we wrote down all the products, all the services. We have this whole whiteboard full of all of the stuff that Michael provides. And then he calls me 2 weeks later and he goes, I've got it. I'm going to do a school community and I'm going to give the $10,000 plus thing, but I'm going to do it for $20 a month. Now, just so you know,
I remember.
and I'm like, cool. That's awesome. So let's, I want you guys to understand the value here. Again, I'm a pitch guy. I like to pitch, but let me just be really clear here. The value you get in the Sunday morning isn't the actual recording or the content. It's actually being in the room.
Yeah.
Okay.
That's what I thought. Yeah.
I've been doing this show with Michael 5 years. For 5 years, every Friday, whatever that is, 5 times 50 times. We've done this show nonstop for 5 years. Let me tell you why. I wanted to be in proximity with Michael so that I could ask him questions. And basically what it was is me show up on Friday and ask, how does CPI work? How does this inflation thing? I don't understand. Like what, like that was the whole thing. Now, just so you know, in school, you get to be in the room, number one.
Yeah.
Number two is you get to meet a lot of like-minded people. But number three is you can pepper Michael with as many questions as you want, as well as he brings on Adrian Hernandez, one of our dear friends. You get to ask Adrian, hey, what about this? What about that? Jason Pritchard, myself, the firefighter, the lumberjack landlord, all of the guests, the community, as well as the other members. One brick at a time, or what is it? Casey?
Brick by brick wealth.
Brick by brick. I was one brick at a time.
Smash them together.
Yeah, I smashed them together. So you get to ask whoever your avatars are, whoever the people you look up to, or where you need help, you get to come to this school.
Yeah.
Now, just so you know, in my community, $150 a month minimum. And then the average is about $600 a month to be in the similar kind of thing. Michael is giving it away for $20 a month. And he basically will coach you on Sundays with his millionaire experts. So folks, get yourself involved, $20 a month, take it for a test drive. All right. I just wanted them to understand that, Michael. That's all. So
no, I got that feedback and it kind of throws me for a loop. So, I sometimes have to talk things out loud to kind of get my mind right. So I appreciate the opportunity to share.
Yeah. There's lots of information on YouTube. You could just get on YouTube and listen, but the fact that you get to be in the room and then you get to raise your hand and say, hey, Michael, tell me again, how does that buy box thing work? How would you do this if you were in Cincinnati, Ohio? I live in this area. How would you approach this? So, okay, let's keep going. So this week, existing home sales, what happened? What is your take on it? Where are we at?
Yeah. So again, I should be wearing my Nailed It t-shirt. So the existing home sales was Thursday, and the experts were calling for 4.12 million. That would have been up roughly 2 or 3% from the previous month, which was, I think, 4.03. And I'm like, I don't know what these guys are smoking. We're doing 4 million or less on an annualized basis. And I nailed it again. The experts were flat out wrong. We did exactly 4 million. In fact, when you step back and you look at the non-seasonally adjusted numbers, we did 349,000, which is the second worst April in 25 years.
Yeah.
Folks, this game of existing home sales is proving to be easy for you and I to watch, right? We told you this was coming. It came. We've told you this for years, what was happening, and we were right. So we did 349,000. That's 28%, thanks to Lance Lambert, Resi Club, below the 25-year average for April. It just shows you how bad the spring selling season was. We have something like 30% more inventory. Prices, sorry, Crash Bros, were up 1.8% year on year. So again, I find it really interesting that people are still calling for nearly double-digit home price crash by the end of the year. Guys, we're already like 4 or 5 months into the year. So, could housing go negative? Yeah, I said at the beginning of the year, it could be down negative 1%. But to say it's going to go down 7, 9, 13 by the end of the year seems like you don't understand price elasticity. And I suggest you go look that up.
Yeah. Yeah. Pay attention, folks. Again, not a crash. Why? Because again, not enough inventory, not enough distress, at least yet. Is it going to come? Maybe. We'll see. Yeah. I got some good questions for you at the end, Michael. I'm going to get through the topics. Okay. But existing home sales, 4 million. You're nailing it. I love it. Yep. Do you still think we're going to end up sub 4 million, 3.9?
Yeah, sub 4. Yeah. Again, it's going to be the hardest year. And I told you that in October of last year that 2025 was going to be the hardest year. And again, when I say that now, I actually want you to smile because we're like 5 months into the year. Yep. It's almost over.
Yep.
Right. And I know it's hard. I know. I talk to mortgage brokers, agents, real estate agents, and it's tough out there. I get it. It's almost over.
Let's keep going. Let's get through it. I appreciate the work. Let's talk about new home sales. What happened this week? What's your take on new home sales and builders?
Yeah, new home sales again. We got it right. The experts were calling for 695. I assumed they would be higher. Why did I assume that? It's because they're meeting the market. I think builders are doing a couple of things, and why these numbers, are significant. So they expected 695. They did 743. That's a pretty significant beat of like 8% or so. But the reason they beat is because they're meeting the market. They're giving all these giveaways, right? Buying down rates. I've seen people go as low as 399 in some slow markets. Also, builders are building smaller homes, right? So they're selling more of that entry level stuff versus the McMansions. So again, what we're seeing in the market today is if you are a seller and you meet the market, which again for most people is payment, not price, just how it works. Builders, specifically the public builders, have an unfair advantage. And, also this week, Toll Brothers, right, the ultra luxury home builder, beat top line and bottom line, which means they exceeded expectations again. So frankly, new home sales and existing home sales are performing exactly like we thought. And we got another month right.
Yeah. And there's a lot of equity out there, right? I mean, there's still a lot of people with money. There's not as if, there's a lot of people that are well capitalized. Mm-hmm. So it all makes sense. Let's talk about the 10-year and then the 30-year. Let's talk about the bonds. Let's talk about the mortgage market. What is going on and where are we? Where are we at now with this whole uncertainty piece?
Yeah, so I'm going to merge this with the next topic, the bond vigilantes, because I think it's probably better to talk about them both first separately. So if you guys aren't paying attention, the bond market, it dwarfs the stock market, right? Lots of people out there, especially in YouTube universe, focus on stocks and they act like the stock market is the king of everything. Where in reality, it's like the little brother to the massive big brother. Which is the bond market. The bond market sets everything. Specifically, the 10-year note is the standard for the risk-free rate of return. And we have seen the bond vigilantes yank the 10-year note higher 3 times now. 3 times in like the last 7 or 8 weeks, which you all need to be paying attention to that. So when was the first time? The first time the bond vigilantes yanked the 10-year higher was when right after Liberation Day, where somebody put up this chart that just showed stupid, reciprocal tariffs, which weren't tariffs or reciprocal. They were trade imbalances. And it was just a complete clusterfuck of messaging. So the bond vigilantes didn't like that and they yanked higher. What happened? Trump was forced to create a 90-day pause. That was the first time, right? Number 2, the bond vigilantes got upset again about what was going on with China specifically, because again, the 90-day pause was ex-China. So what happened? The bond vigilantes yanked the 10-year note higher, forced Trump to respond, and he created a 90-day pause. Now what happened? Well, this tax bill, this big, beautiful bill, is estimated to add $7 to $9 trillion in debt on top of a crazy amount of debt that we already have. The bond vigilantes yanked the 10-year note above 4.5. They yanked the 30-year note over 5. The bond vigilantes expected more. They expected less spending. They expected the administration to lower the debt, not add 20% to the debt. And the bond vigilantes are not happy. And, as of this morning, I believe the 10-year is still above 4.5 and the 30-year is still above 5. And the bond vigilantes, they could make this very painful. If the bond vigilantes continue to be unnerved by what is proposed in that big, beautiful bill, they will take the rate significantly higher, which will force the Fed into a corner where there are only 2 bad options, right? This is like a legit concern I have. So let's just say for a minute, over the next 6 months, the 30-year goes to 6% from 5. The 10-year note goes from 4.5 to 5.2. Stuff breaks in the U.S. economy, just flat out breaks. So now is the Fed. It's in the corner. It's trapped. It can't go anywhere. They either A, let the system burn down, or B, they become the buyer of last resort. They buy all the treasuries. We go right back to zero and they blow up the bubble again. This is like a legit concern. And, we've got to be paying attention. I suspect, like the other two times the bond vigilantes yanked rates higher, that there will be some reaction by the administration that gives the bond vigilantes more of what they want. But who knows? This could get ugly fast.
How do you see this playing out? Is this something that plays out over the next 3 to 6 weeks? Is this something that plays out all summer? How is your think about timeline specifically of how this bond issue you just laid out? How does it play out?
I'm going to tie it with my call that the first 6 months are chaotic. So this has to be resolved by July 20th. And again, let's not forget, we probably couldn't have a better Treasury Secretary than Scott Bessent today. All right. If you don't know who Scott Bessent is, pre being the U.S. Treasury, you need to go work that out. Right. He was involved in breaking the UK market. Right. He knows how the system works better than everybody on the planet X 10 people or something. Right. He's legit a superhero when it comes to this stuff. So we couldn't have a better person. I know he sees it. I know he's communicating. And I am going to assume that he is able to move the ball in the right direction. But it's not going to be easy. It's not going to be fun. So I'm going to say July. We have to know by July 20th, which will be the end of the first 6 months or chaotic call I had earlier.
Got it. So we basically the next 7 weeks, we're going to see this play out. How the bond vigilantes play out. It's interesting too that you mentioned Scott Bessent, that Trump would say something would happen. For a while there during April, I had CNBC on every day, just all day muted, right? And I could see things kind of the headline flashing, but Trump would say something, the stock market would overreact, and then Scott Bessent would come out, and then he would say something, and then things would calm the water. And so he really is, in the financial markets, a guy that really calms the waters with the bond market, with the stock market. So right now, when you say things break, what does that mean? Define that for our audience.
Well, again, if you see rates shoot up higher, you're just going to see the economy crater. Right? We are a debt-based system. Right. So you're going to see housing get even worse. You're going to see autos get even worse, furniture get even worse. You're going to have companies not borrow. You're going to have companies not invest. You're going to have credit card rates. You're going to have defaults. You're going to have jobless claims. It would send the economy into a nasty recession. That's what I mean by break.
Got it. So on the other side of that, when you say if the economy, quote unquote, breaks, we see that happen, we're probably going to see Fed jump back in. They're going to start buying back treasuries. They're going to start. Give them an example. So we know in 2008, when all that melted down, was there any time between 2008 and 2025 where they jumped back in? COVID, right?
COVID for sure. Yeah. COVID.
Are there any other times in that time period where they jumped in and intervened and started buying back?
Yeah, Trump 1.0, right after the initial tariff or trade war with China, they came in and lowered rates a couple of times. I think that was 19 or maybe it was 18. I haven't looked, but yeah, the Fed has jumped in. They've jumped into the .com crisis. I mean, they jumped in. They've basically, the Fed put was a thing that I think Powell wants to quit. And the Fed put was basically we're going to go to zero. We've been running a series of bubbles since. Let's just call it 1999. And, maybe the answer is, burn the system down, start over. Maybe. But history says they won't. The other thing we should have added to this list, we'll throw it in here, is Ray Dalio. Ray Dalio came out after Moody's downgraded the U.S. debt to be the third and final credit rating agency to do that. And Dalio said Moody's missed the point. And what Ray Dalio was saying is It's not the debt picture, it's the Fed. And Ray Dalio is basically saying, hey, the Fed's going to be put in a tough spot, and the only option they're going to have is to print money. And, Ray Dalio is like, watch out, guys, inflation 2.0 is coming. And it's going to be asset inflation. So when I hear Ray Dalio talk about all that stuff, I'm like, gosh darn it, I'm so happy I've got 30-year debt. I'm so happy I have, real estate that cash flows, pays for itself. If we get back to a world where, inflation goes 4, 5, 8%, that's going to be bad for most people, but good for asset owners, right? Guys, this shirt I'm wearing, inflation's a feature
to get rich.
Yeah, inflation's a feature, not a bug. And Ray Dalio's like, buckle up, it's coming.
So Dalio's call is, in fact, that
the Fed's
they go back to the print, meaning that rates come down, we start printing money. In the short term, everybody goes, yay, yippee, we're okay, we're going to be okay now. But really what happens is we get into this whole hyperinflation or some inflation. Not hyperinflation.
Not hyper, high inflation.
Yeah. High inflation. Okay. It's a good thing we got you, Michael.
We're trying.
Okay, so let's talk real quick. Anything else with Trump, the tariffs, anything else that you kind of see playing out over the summer? We're now in the summer months, summer season.
Yeah. Again,
what's going on with, what happens with Trump and tariffs and all of it?
Until this morning when I opened up my to do the thing I do every day, which was read the financial news, I was pretty sure that uncertainty had peaked and every day was getting better.
Yep.
Then this morning I saw a couple of posts like Apple's got to pay 25% tariff on iPhones, and the EU is going to pay 50% across the board. And again, I think a lot of people look at that as more uncertainty. And
stand by.
Sorry, I pulled out Mike. Sorry. So again, so what happened is, Trump had these two announcements, and I think a lot of people are going to freak out again. And I'm like, guys, haven't you learned already? Trump throws out these wild and crazy things to get a reaction.
Yep.
I think what's happening in the EU is we've had a lack of progress, and Trump's just going to throw a grenade into it to force progress. So, I'm going to stand by my statement that every day is still getting better, even though, we have these crazy headlines, which will freak a lot of people out. It's just how he works. You can like it or not, but at least understand it. And, I'm going to keep thinking that until I'm proven wrong. Cause again, he could come out and, do whatever he wants. He's, via executive order. So, So these headlines this morning don't concern me. I think they're just a kick in the ass to get negotiations going. He's not happy where the EU is. Getting a negotiation done with the EU is hard. Lots of countries. Also very important. One of our largest trading partners in mass. So I think what he did is just like, I don't see any progress. I'm going to throw a grenade. We'll see what happens.
Here goes the roller coaster. Let's keep our seatbelts on. So, Michael, let's finish strong on opportunity. So what does the one rental at a time investor, this is the year of the investor.
Yep.
This is the year of the deal maker. This is the year of the transaction engineer. Let's get out. Let's be, even if you're just getting started, one rental at a time. What does the one rental at a time community do from here? Where are the opportunities?
Yeah, your job doesn't change. Everything I've been saying all year is still accurate. Still the year of the investor. I mean, just look at existing home sales. The fact that we did 4 million, the fact that April was the second worst in the last 25 years is a signal, and frankly, it should be permission for you to write disrespectful offers, don't pay list price, ask for credits, get repairs, and make sure you're writing deals that cash flow, regardless of cost of capital. And again, the higher rates go, the better it is for investors, because we only write, at least a one rental at a time investor, because we only write deals that make sense day one. So, rates go to 8, don't care. Rates go to 9, don't care. Rates go to 10, don't care. Just write better deals. And again, it's a numbers game. I know you guys don't believe me when you hear this, but I've lived this story so many times. You got to write lots of offers. You got to follow up lots of times, but the process is simple. So just do what others won't, and you'll have what others don't. So there you go.
I love it. Do the work, folks. Get yourself involved in school. $20 a month. Sunday, we're going to be live. Now, what's different is Michael and I will be live, but you'll be in the room and you get to ask questions. You get to, like, there's so many things what we just talked about, Michael. I've got 90 more minutes of questions about when you talk about the EU, the trade, the tariffs, how does this all play? Ray Dalio's point of view, burn it down to the ground. What is that? Like, there's so many things there that we could unpack. Folks, get involved with school. $20 a month. Take it for a test drive. Sunday morning, 8 a.m. Pacific time. Michael and I will be there live. And we're going to stay until every question, right?
Mm-hmm.
Do you have a deadline on Sunday? No.
Nope.
I don't either. Every question will be answered. We'll interact. We'll dialogue. We'll coach you up on your buy box, whatever you need. Creative financing. If rates go to 8, 9, 10, Michael, better for us because we're just going to write our own terms with seller financing.
Amen, brother. It's going to be a good time.
Have a great Friday. Thank you, Michael, for all you do. I'll see you Sunday.
Later. See you guys Sunday.